The stock market just had one of its worst days of 2024 yesterday, with the Dow Jones falling almost 500 points. And there are two main things that led to the stock market drop. Number one, we got new manufacturing data, which said that manufacturing in the United States shrank for the fourth straight month. And you have a lot of economists saying that this could be indicating a potential recession or a slowdown or shrinking in the economy. And secondly, we got new jobless data, which says that jobless rates shot up faster than expected. And later today on Friday, we're going to get some more unemployment data, so you're going to want to keep an eye out for that. But then what's even more interesting is after the markets closed yesterday, Intel came out and they said that they're running into some financial issues. And to combat these financial issues, they're going to do a restructuring and they're going to be laying off 15,000 employees to help turn around the company. So this created a little bit of shock in the stock market because, well, people got worried about the economy. But the interesting thing about this is this data, the jobless data and the economic data, are both good news for the Federal Reserve Bank in terms of interest rate cuts. So we've been talking about the Federal Reserve Bank meeting where Jerome Powell, who's the chairman of the Federal Reserve Bank, which is a central bank in the United States, said essentially that now with inflation starting to cool down, they're thinking about cutting interest rates. Now, when do you normally cut interest rates? You don't cut interest rates when you're in a booming economy. You cut interest rates when the economy is slowing down. And so this slowdown data of the economy slowing down is good news for the Federal Reserve Bank to fuel a potential interest rate cut, which interestingly, now the stock market is looking at bad news. Because previously, anytime we got bad economic news, the stock market rallied because investors were saying, hey, this bad news is good news for the stock market because that could mean more interest rate cuts, which could stimulate the economy. Now we're getting data which is saying, hey, this bad news in the economy might be bad news because we could be entering a recession. For example, the bank, UBS, said yesterday that an economic pullback is likely ahead. So kind of a strange 48 hours where people started to shift their opinions on the economy, and now a lot of people are starting to get worried about a potential economic slowdown. So I want to break all this down today, but first a quick reminder that on August 15th, 1971, that was when President Richard Nixon took the dollar off of the gold standard, which changed the way that our money worked forever. And because of that, this year on August 14th and 15th, 2024, we are hosting our biggest virtual wealth building event. It's completely free. It's my investor workshop where we're going to be going over, number one, how money has changed over the last 5 decades and over the last 5 years. But then number two, how you can find economic opportunities in this new changing economy during a time where we are seeing this economic slowdown, during a time where inflation is impacting a lot of people, during a time where interest rates are still high, during a time where the economy is starting to slow. How do you find financial trends? How do you invest your money? How do you build your wealth? It's a completely free workshop. I would love for you to join. All you have to do is register because it's free, and I got the link for you to join down in the description below. Now, jumping into this data, starting with what's going on with jobless claims. We saw the biggest jobless claim data last week. It was 249,000 initial jobless claims, which was the largest number since August 2023, so about 1 year ago. And the reason why this is significant is because, well, unemployment numbers are rising. Now, based off of historical numbers, 4.1% unemployment is extremely low. But if it keeps going up, that's a problem for people that are looking for a job. And that's the concern. Now, we're going to get more data on the unemployment numbers today, so I'm not going to go too deep into that. But the reason why this is important is because we are seeing a shift in the job market. I have a video coming out, I think tomorrow, about the job market, so you're going to want to watch that. But we're seeing a shift in the job market where more and more employers are saying, we don't need as many employees as we have. We overhired. We got to let go of some of these employees. We only want the good employees. And so you're starting to see this shift in the job market where employers are saying, you know what? If you don't want to work for us, fine, go find somebody else. And employees are having a tougher time trying to find that other job. So we're seeing this shift in the job market. But then, beyond that, if you take a look at how people are reacting to interest rate cuts or potential interest rate cuts, that tone is starting to change for the first time in more than a year, it feels like. Because yesterday we got the news that the Bank of England is now cutting interest rates. So the Bank of England is kind of like the Federal Reserve Bank, but for the United Kingdom. And they cut interest rates for the first time since the pandemic started. And they kind of followed what the United States has been doing for the last 4 years, where they worked to cut interest rates when the pandemic happened, and then they worked to raise interest rates after the inflation problem happened. And now the Bank of England is cutting interest rates. Now, what does this really mean for us? Well, the thing that you want to pay attention to as an investor here is, could this indicate that, yeah, maybe we will be cutting interest rates in the United States? Now, the reason why I want to pay attention to this is because just because we cut interest rates, or just because we might cut interest rates, doesn't necessarily mean we should. And so this is where now, if we take out the emotions, take out the politics, take out the kind of feelings around this, what do higher interest rates do? Higher interest rates are there to cool down the economy. Higher interest rates are there to make borrowing a little bit more expensive, and higher interest rates force people to be a little bit smarter with money. And what do I mean by smarter with money? Well, I mean it's more expensive to borrow money. So you're gonna have to make smarter decisions with your money. If you're gonna invest your money and you have to pay more money to borrow it, you're gonna be a more savvy investor. You're gonna be more sophisticated with your investments, because you don't wanna just throw your money into anything, because now you have to get a real rate of return to justify your investment. Likewise, if you're just gonna go out and buy some Gucci, well, now that Gucci becomes even more expensive because you have to pay a higher interest rate to borrow that money. So these higher interest rates kind of force people to be a little bit more sophisticated, a little bit smarter, but they also force you to pay a little bit more money, and it help you if you're a saver. If you're saving money and you have a high yield savings account, higher interest rates mean you finally get a rate of return on your money, which is great. Lower interest rates are kind of the opposite. Lower interest rates are there to stimulate the economy. But what does it mean to stimulate the economy? It means get people to spend money. Now, when do you want to stimulate an economy? You want to stimulate an economy that's been slowing down. So if you want to get people to spend money, what does that mean exactly? Because if you're buying with cash, interest rates don't only mean anything. Interest rates only matter when you're buying things with debt. So now if you're going out and buying the Gucci and interest rates are lower, that means you can finance money to buy the Gucci cheaper. You can finance money to buy the BMW cheaper. You can finance money to buy other dumb things cheaper. Makes it a little bit easier. Makes your credit card debt a little bit cheaper. Not to mention the fact that if you're an investor, lower interest rates mean you can access more debt. And that means you can make more investments. One of the things that we saw a big boom of during the pandemic was dummy or zombie companies. What are zombie companies? These are companies that weren't making any money, but they were funded because of cheap debt. They were funded because of all these venture dollars. That's why we saw a huge boom in bankruptcies after interest rates went up, because now companies that were essentially spending $1 to make 80 cents could no longer survive. And the reason why they were able to survive before is because venture capital firms kept fueling dollars into these companies, hoping that they would one day eventually make a profit. And even for the venture capital firms, it wasn't that big of a deal if the companies weren't making any money, because they could borrow money for essentially free because interest rates were so low. So that's what then fuels inflation, because everybody keeps borrowing money, everybody keeps spending money. And so this is where now I want you to understand the whole system. I want you to understand the whole game. There's a lot of signs pointing to potential interest rates being cut later in 2024. The Bank of England just cut their interest rates. Jerome Powell said earlier this week at the Federal Reserve Bank meeting that there's a good chance that they might start cutting interest rates in September. And now we got some more rougher economic data talking about how jobless numbers are rising and how manufacturing is cooling. And if inflation doesn't suddenly shoot up in the next few months, then that could be more fuel on the fire for the Federal Reserve Bank to keep cutting interest rates. And when all of this happened, what we saw was a big movement in the last 48 hours of people moving money from stocks to bonds. Now, this is going to get a little bit more technical, but if you stick with me, I will do my best to make it all make sense. So when we look at institutional investors, these are investors that are investing big sums of money, millions and billions of dollars, hundreds of millions and billions of dollars. They're looking for where can they get the best yields, the best returns on their money. And when they heard about these things happening in the economy, what we saw was a lot of people selling off in the stock market. We saw one of the biggest sell-offs in 2024, which is really not that big of a deal. But the thing that's more noteworthy is that we saw a lot of money moving to bonds, Treasury Bonds, which then brought down the yields, meaning the return on these bonds. So bonds are debt. Treasury bonds are loans you can make to the government. So anybody can buy a Treasury bond. A Treasury bond is a loan you make to the United States government. And there are treasury bonds that are 1 year long, 10 years long, 30 years long. They're called treasury bonds, notes. There's different words, but they're all treasuries, meaning loans made to the United States government. But the reason why this is significant is because when more people are buying the bonds, the yield, the interest rate that you get goes down, while the price goes up. And so as interest rates go down, if interest rates get cut by the Federal Reserve Bank, that would mean that these treasury yields would also go down. The interest rates that you get would go down while the price of these bonds go up. And so this is where now a lot of bond investors are looking at this and say, we might be seeing risk in the stock market. And so maybe we should buy some more bonds, which are considered more of a safer investment. Now, I don't want you to get too deep into this because you as an investor, you don't need to get caught up into the day-to-day stuff. The only reason why I'm saying this is because it's caught a lot of headlines yesterday. But the real thing that I want you to understand is that there are shifts happening in the economy, okay? Let's just lay that out there. That's what you want to understand, that there are shifts happening in the economy. And the main thing you want to understand now is how can you build wealth? And you don't need to be a trader. I'm not a trader. These day-to-day things don't really matter as an investor. What you want to pay attention to is, okay, these changes are happening in the economy. Where can I find a financial trend? And how can I invest my money long-term? Because if you have a dollar cost investing strategy, a dollar cost average investing strategy, where money is automatically invested into some funds, like say the S&P 500, but I'm just a random guy on YouTube. I can't tell you what to do. That's a disclaimer. But if you're just investing your money to these funds, it doesn't matter what's happening in the markets. It doesn't matter what the media is saying. It doesn't matter what's happening in one day, because guess what? No one knows what's going to happen on Friday. The stock market could be booming on Friday. It could be crashing on Friday today. It could be booming on Monday. It could be crashing on Monday. And so you have a lot of people that when you see these big momentum swings, people panic and they create all these huge theories. Like in the last 48 hours, we saw all these big institutions, these big name investors come out and say a recession is coming. And all the media companies were having a blast talking about it. So this creates fear, it creates panic. But what I want you to do is just cut through the noise and say, okay, this is what people are saying. This is what people are doing. Cool. But now don't let that influence your day-to-day investment decisions, because your investing has to be done based off of a long-term basis, not based off of short-term swings. The only thing you want to really be doing when you see big downward swings is buying more. Not panicking. People use downward swings as a time to panic. That's when I want you to be staying calm and looking for opportunities. See, my goal here is to help you understand what's happening, but not to help you sway these trading decisions. I want you to be a smarter investor and not somebody who's getting caught up with the emotions of the media and with the emotions of the markets, because guess what? The stock market is emotional. We have an election coming in November. You bet that that's going to create more emotion in the market. We might be seeing interest rate cuts coming soon. That could create more emotion in the market. We have wars happening internationally. You bet that can create more emotion in the markets. But emotion is the enemy of profits. So if you want to build wealth, you got to be able to cut through the emotion. You want to understand what's happening, but not let the emotions dictate your investment decisions. That's really the key to be a successful investor, is you don't want to let these emotions dictate your investment decisions, because you want to make your investment decisions based off of financials, not the emotions. You want to understand what's happening, but you want to be able to understand it in an unbiased way. That's why we created Market Briefs as an unbiased newsletter, to break down what's happening, when it's happening, into a fun and easy read. That way you understand what's happening, but you don't need to go and panic when you see bad news. You don't need to get super excited when the market is booming, because guess what? You're going to see good days, you're going to see bad days, you're going to see market booms, you're going to see market crashes, you're going to see economic booms, you're going to see economic crashes. You want to pay attention to the trends, you want to pay attention to the opportunities, and you want to be a long-term investor if you want to be able to build the real long-term wealth, but that allows you to really, in order for that to happen, you have to be able to cut through the emotions, find the opportunity, and stay calm to actually be able to take advantage of it. And with that, I'll see you tomorrow.